Determine which of the following statement is least accurate. Which one is incorrect basically. Okay, so first we'll have to go through the question and then only we'll be able to, options we'll have to identify. A company reports increase in its debt equity ratio from 0.4 to 0.5. So effectively the debt equity ratio has increased. If the debt equity ratio is increasing, that means management is more inclined towards taking debt in their books. That means they are preferring debt capital. That means in future they will increase their percentage of debt in the total capital. All else remaining unchanged. This increase will result in increase in equity beta with asset beta remaining unchanged. Now understand. Equity beta comprises of both business risk and financial risk. Okay. Equity beta is equals to business risk into financial risk. It has two components. So if any one of the component changes, equity beta will definitely change. In this situation, my debt to equity ratio is increasing, which means my financial risk is increasing. I will take on more debt and that means my financial risk will increase. If my financial risk goes up, then my equity beta also goes up, which means that this statement is correct. From asset beta perspective, asset beta is calculated as business risk into financial risk by financial risk. Think, because equity beta divided by financial risk, that is what we do to calculate asset beta. That means effectively we remove our financial risk and asset beta only represents business risk. That means any change in financial risk will not change my asset beta. Hence this statement A is correct statement. Very intelligent and a correct statement. Okay, got the point? Moving on to next. Management identifies a project which has IRR equal to its existing WACC. So the project has IRR equal to WACC. Whatever WACC of the company is, IRR is same as that of WACC. Means it is equal. Company has strong access to equity market and plans to raise entire fund of the new project by issuing equity. So they plan to fund the entire thing. Entire fund will be raised via equity only. Full fund will be raised via equity. Hence management is most likely to accept the project as project returns its cost of capital. Incorrect. Because equity is a costlier source of finance than debt. We already know that post we have done cost of capital and at least this much. We know equity is a costlier source of finance because equity bears highest risk. A WACC of the company comprises of both debt and equity, and debt is a cheaper source. That means debt actually pulls WACC downwards. If you see any of the questions WACC we have calculated, WACC is a number which is somewhere midway. It is lower than equity cost and higher than debt cost, which is obviously a mathematical logic that debt is a lower number, so it pull it downwards. Equity is a higher number, it pull it upwards, and the resultant or the weighted average somewhere remains in the middle. However, and that means this WACC also reflects, this IRR or WACC also reflects that middle number. However, if company goes ahead and use the entire debt as an incremental to finance the project, then basically company is not using the averaging effect of debt. It is basically taking entire capital in form of equity, and the entire cost of equity is the cost of new project, and that cost obviously will be on the higher end. And since the question has already mentioned that IRR of the project, that IRR of the project is equal to WACC of the project, that means any increment in WACC will leave my project non-fruitful and management will reject the project. Hence this statement sounds incorrect, that if this happens then management will not accept but actually will reject the project. B is an incorrect statement. Lastly, if risk-free rate in economy increases, it will result in cost of both equity and debt capital to rise, which is absolutely true. Because risk-free rate is an underlying concept of each and everything. At the time of interest rate formation or interest rate calculation, NRFR, RRFR, we did a nominal risk-free rate and interest rate. If you recall time value of money, RRFR was a component. And needless to say, bond yield plus risk premium, which was the third method of calculating equity, there also it was bond yield means the bond yield rate means the interest rate plus the risk premium, and interest rate is actually comprises of risk free rate implied in it. So if in overall economy risk free rate increases, then cost of both debt and equity will increase, because that is an ingredient for both. You cannot remove that. If you calculate CAPM, if you recall CAPM also, it respects risk free rate, RF plus RM minus RF into beta. Everything else remains unchanged. If RF goes up, then my KE also goes up. So that's why C is also a correct statement. B is an incorrect statement.